What happens when a huge bonus you weren't expecting suddenly creates a massive tax problem? Well, let me walk you through a real client situation that demonstrates a combo tax strategy I've used often in my career. This client exceeded his sales goals and got rewarded with bonuses that were way higher than expected. That's great news, but that extra income created a serious withholding shortfall that put him under the IRS safe harbor threshold, meaning penalties on top of his surprise tax bill. What made this interesting is that he also owned company stock from ESPP and RSU shares that were down in value and sitting at a loss. He also had legacy brokerage holdings that had been sitting untouched for years. We turned what looked like a tax disaster into a multi-year charitable giving plan, diversified his portfolio, eliminated the penalties, and dramatically reduced what he owed. I'm Matt Nelson, certified financial planner with over 25 years of experience helping clients use their stock compensation to retire successfully. Here's exactly what we did. Now let's set the stage. This is a hypothetical scenario for illustrative purposes, but it reflects a pattern I see regularly among high earners with stock compensation. Our client had budgeted for a certain income level based on his base salary plus typical bonuses, but this year he absolutely crushed his sales targets and he received bonuses 6 figures higher than planned. That's a great problem to have, except here's what happens when compensation spikes late in the year. Employers typically withhold on bonuses at a standard flat rate, and often that's just 22%, which can significantly understate the actual tax owed when you're already in a high tax bracket. When bonuses surge unexpectedly, that gap between what was withheld and what you actually owe can be big. And when you also fall short of what the IRS calls the safe harbor threshold, you don't just owe the difference, you owe penalties on top of it. Now here's where things stood for this client before we got started. Federal taxes were estimated at around $130,000 for the year, and to avoid penalties, he needed withholding and estimated payments to cover about $117,000. But withholding to date was only about $102,000, which left him with a shortfall of nearly $28,000 in federal taxes owed, plus the underpayment penalties. And on the state side, estimates showed he still owed about $15,000. So this wasn't just a big tax bill, it was a penalty situation, and it was coming from two different directions. A $20,000 long-term capital gain from portfolio activity during the year, and a significantly higher bonus income. Now, he could have just written checks for the estimated taxes, but that's where most people stopped thinking, and we just kept digging. Over several years, this client had participated in his company's ESPP, and he'd received RSUs as part of compensation. After these shares vest or are purchased, you own them outright, and their future price movements create capital gains or losses. In his case, some of those shares were underwater. He'd held onto them after vesting, the stock price had declined, and now they represented unrealized losses just sitting in his account. Most people see that as a disappointment, but in tax planning, it's an opportunity. When you sell investments at a loss, those losses first offset capital gains dollar for dollar. After that, up to $3,000 can offset ordinary income for the year. Any remainder carries forward for future tax years. We looked at his holdings and identified underwater ESPP and RSU shares that could be sold, and the combined cost basis was about $92,000 for a sale that would harvest about $32,000 in capital losses, and we knew exactly how to put them to work. So we sold the underwater shares, generated $60,000 in cash, and harvested the losses. The losses first offset his $20,000 long-term capital gain, plus $3,000 was able to offset ordinary income. That left a small remaining balance to carry forward to benefit him in future tax years. When making a move like this, you got to pay attention to the wash sale rule. The IRS prohibits claiming a loss if you repurchase the same or substantially identical security within 30 days before or after the sale, but since we had no intention of buying back the same company stock, it was fine. Another note on the wash sale rule when you're using ESPP or RSU shares is that if you're participating in the ESPP plan, or you get RSUs as part of your regular compensation that are vesting on a quarterly or annual basis, be careful that you don't sell those underwater shares too close to a date when you'll receive new ones. That would actually violate the wash sale rule. The loss harvesting was a meaningful step, but the bulk of the tax problem remained. So here's where the planning got creative. We already knew from reviewing prior tax returns that this client and his spouse gave to charity regularly. They just didn't have a strategy around it, so they were simply writing checks each year and hoping to itemize for a deduction. So that opened the door to a donor advised fund, or a DAF for short. A DAF is a charitable giving account held at a 501c3 sponsoring organization, and you make irrevocable contributions, receive an immediate tax deduction for the market value of what you contribute, and then you can recommend grants to your chosen charities over time. You're able to give on your schedule, not the calendar's, and the account can also be invested and grow tax-free while you decide where to give. The real power for high earners is that you can contribute appreciated stock directly. This way, you avoid paying capital gains on the appreciation, but you still receive a deduction for the current market value. It's one of the more tax-efficient charitable moves available. Now, this client also had legacy investment holdings he'd owned for many years with very low cost basis. These weren't part of his current investment strategy, but selling them outright would have triggered a significant capital gain. We contributed $30,000 worth of those legacy positions directly into his newly established donor advised fund. He avoided the capital gains on the embedded appreciation and got a $30,000 charitable deduction. Here's what the numbers looked like after both tax moves. Federal taxes dropped from $130,000 to about $112,000. His new 90% safe harbor threshold came down to a bit over $100,000, and his current withholding now cleared the bar, so penalties were avoided. Remaining federal and state balances owed dropped to approximately $10,000 each, so instead of a $43,000 combined surprise bill plus the penalties, he was looking at $20,000 total, a number he could manage without scrambling. With the tax strategy in place, we turned back to the portfolio to bring it full circle. The stock sale had generated $60,000 in proceeds, and we put all of that back to work. His portfolio drifted out of balance over time anyway, with certain positions underweight relative to his target allocations. But instead of selling winners and triggering new capital gains to rebalance, we used the $60,000 of fresh cash to just buy into those underweight positions. The result was we reduced his concentrated company stock risk, he had a better diversified portfolio, and target allocations had been restored, all without triggering additional taxes in the process. Now here's the final scorecard. The loss harvesting eliminated $20,000 of capital gain liability, it delivered a $3,000 income offset, and generated a carry-forward deduction for future years. The donor advised fund contribution added meaningful charitable deductions, eliminating penalties and dramatically reducing what he owed by over $20,000. And his portfolio was now more diversified, matched his financial plan. The part that really resonated with him and his spouse was they now had multiple years of charitable giving capacity sitting in their donor advised fund. They were already planning to give to their favorite causes over the next 5 years plus anyway, but now they can make those grants on their own timeline while already having captured the full tax benefit up front. And that's what made this feel like a real win, not just financially, but personally. This is what comprehensive tax planning looks like. Not just one strategy in isolation, but coordinating to solve multiple problems with one connected plan. If you're a high earner with RSUs or stock options and you're wondering how to reduce your taxes, optimize your benefits, and build toward retirement, this is what we do at Perspective 6 Wealth Advisors. Schedule a free vision call using the link below, and let's bring your full financial plan into focus.